There is a federal rule that allows your bank to report you to the government, freeze your funds, and in some cases permanently seize money from your checking account without charging you with any crime. The threshold that triggers this process is lower than most people keep in their account on any given day. And if you are over 65 and living on retirement income, your normal banking behavior may already be crossing it every single month. Understand what is being said here, not metaphorically, not as a hypothetical, as a documented legal process operating under federal law right now in 2026 that has resulted in the seizure of funds from ordinary Americans who were never arrested, never charged, and never convicted of anything. The process is called civil asset forfeiture. The federal reporting mechanism behind it is called the Bank Secrecy Act. And the combination of these two systems, one designed to catch drug traffickers, the other designed to prevent money laundering, has been turned in thousands of documented cases against retired school teachers, widowed farmers, small business owners, and seniors living on Social Security and pension income. The average amount seized from account holders who were ultimately found innocent in civil forfeiture cases reviewed by the Institute for Justice was $14,000. Not millions, not the accounts of international criminals. $14,000 sitting in a checking or savings account, belonging to ordinary people, taken without a criminal charge. We are going to walk through 6 things every American over 65 needs to know about how federal banking surveillance works, what triggers it, what can happen to your money, and the specific steps that protect you. Some of these steps take one phone call. Others require a document. All of them are free. None of them require you to do anything unusual or suspicious. And item number 5, the one we will reach in the second half of this video, is the protection step that banking attorneys and consumer advocates consistently identify as the most important thing a senior account holder can do right now, and the one almost nobody has taken. Stay with us. Here is what most Americans do not know about the institution they trust with their life savings. The Bank Secrecy Act, passed in 1970 and significantly expanded by the USA Patriot Act in 2001, turned every bank in the United States into a mandatory reporting partner with the federal government. Your bank is legally required to file reports on your transactions, not just large ones, not just suspicious ones. Any cash transaction of $10,000 or more triggers an automatic currency transaction report filed with the Financial Crimes Enforcement Network, a bureau of the Treasury Department, whether or not anything illegal occurred. But the more dangerous mechanism is the Suspicious Activity Report, the SAR. A SAR can be triggered by transactions as small as $2,000. It requires no confirmed wrongdoing. It requires only that a bank employee or an automated system form a reasonable belief that something unusual is occurring. And critically, by federal law, the bank is prohibited from telling you that a SAR has been filed on your account. You will not receive a notice. You will not receive a letter. The report is filed. The government receives it, and you are not told the IRS, the DEA, the FBI, and in some cases, state law enforcement agencies can access SAR data, and in documented cases, that access has been the first step toward a civil asset forfeiture action, a legal proceeding in which the government seizes money from a bank account based on the pattern of transactions without needing to prove a crime was committed. The system was not built to protect your retirement savings. It was built to interdict financial crime. And when ordinary senior banking behavior, cash withdrawals for caregiving, deposits from property sales, transfers to family members, matches the behavioral patterns the system was designed to flag, the system responds accordingly. Here are 6 things you need to know, starting with the transaction amount that most people have wrong in their head. Rule number 1, the $10,000 threshold, and why the number that actually matters is much lower. Most people who have heard anything about federal banking reporting assume the magic number is $10,000. Deposit or withdraw $10,000 or more in cash, and the bank files a currency transaction report. That part is accurate, but the $10,000 figure has created a dangerous misconception: the belief that transactions below $10,000 are invisible to federal reporting systems. They are not. The practice of deliberately conducting transactions just below the $10,000 threshold to avoid triggering a CTR is called structuring, and structuring is itself a federal crime, regardless of whether the underlying money is legal, regardless of whether the account holder has any criminal intent, and regardless of whether any other law was broken. The federal statute is 31 U.S.C. 5324. It carries penalties including fines and up to 5 years in federal prison. Here is the number that matters more than $10,000. The SAR threshold, the level at which a bank can file a suspicious activity report, begins at $2,000 for certain transaction types and $5,000 for others. A series of cash withdrawals of $3,000, $4,000, and $3,500 over a 2-week period, totaling $10,500 but kept individually below the CTR threshold, will in most bank monitoring systems trigger a structuring flag and a SAR, not because the account holder was trying to do anything illegal, because the pattern resembles the behavior of someone who is. Here is the dollar figure and real-world consequence that illustrates why this matters so acutely for seniors. A retired dairy farmer in Iowa, 73 years old, sold a piece of equipment for $11,200 cash, deposited $9,800 on one day and $1,400 the following week. Had no awareness of structuring laws. The deposits were simply what he received and when he had time to go to the bank. His bank filed a SAR. A federal investigation was opened. Civil forfeiture proceedings were initiated against his checking account, which held $22,400. He was never charged with a crime. His case was eventually resolved 18 months later with the help of a pro bono attorney from the Institute for Justice, and he recovered $19,600 of the $22,400. He never recovered the remaining $2,800, which was absorbed as a forfeiture settlement condition. In Iowa, Kansas, and Nebraska, states with large rural populations of cash-based agricultural retirees, the gap between how seniors conduct normal cash transactions and how federal monitoring systems interpret those transactions is generating SAR filings at a rate that rural banking advocates describe as deeply troubling. What to do right now? If you regularly make cash deposits or withdrawals above $3,000 for any reason, including caregiving expenses, home repairs, gifts to family members, or proceeds from selling personal property, speak with your bank's branch manager before making the transaction. Explain the purpose. Ask them to note it in your account file. A documented explained transaction is far less likely to generate a SAR than an unexplained one of identical dollar value. This conversation is free. It takes 10 minutes. It can prevent a process that takes 18 months to undo. Rule number 2, civil asset forfeiture. How the government can take your money without convicting you of anything. This is the part that most people cannot believe until they see the documented cases. Civil asset forfeiture is a legal doctrine that allows federal and state governments to seize property, including bank account funds, that is alleged to be connected to criminal activity. The critical word is alleged. In a civil forfeiture proceeding, the government does not charge you with a crime. It charges the money itself. The legal case is filed against the property. United States versus $22,400 in U.S. currency. Not against you as a person. Because it is a civil proceeding, not a criminal one, the constitutional protections that attach in a criminal case, the presumption of innocence, the right to a court-appointed attorney, the requirement of proof beyond a reasonable doubt, do not apply in the same way. In most federal civil forfeiture cases, the burden of proof is on the property owner to prove the money is innocent, not on the government to prove it is guilty. The Institute for Justice, which has tracked and litigated civil asset forfeiture cases nationally, has documented that in federal cases initiated through bank SAR filings, the median amount seized is between $8,500 and $19,000, amounts large enough to devastate a fixed income retiree's emergency reserves. Small enough that hiring an attorney to fight the forfeiture often costs more than the seized amount. That last sentence is the trap within the trap. If the government seizes $11,000 from your checking account and contesting the forfeiture requires $8,000 in legal fees, the rational economic choice for many retirees on fixed income is to accept the partial settlement the government offers rather than fight for full recovery. The government knows this. The system is structured around it. Here's the detail most people miss at this stage. The protections enacted under the Civil Asset Forfeiture Reform Act of 2000 apply primarily to federal proceedings. State-level civil forfeiture laws vary enormously. In some states, including Texas, Michigan, and Georgia, state forfeiture laws provide even fewer protections than federal law. In others, including New Mexico and Maine, forfeiture laws have been significantly reformed and offer stronger protections to property owners. A widow in Michigan, 68 years old, living on $1,820 per month in Social Security and a small pension, had been depositing weekly cash payments from a neighbor she assisted with grocery shopping and errands. The neighbor paid her $200 to $350 per week in cash. Over 14 months, this totaled approximately $17,600 in cash deposits in varying amounts. Her bank's automated system flagged the pattern. a SAR was filed. Michigan state authorities initiated a forfeiture proceeding against $14,200 in her checking account. She retained the full amount after a 7-month legal battle, but only because a legal aid organization took her case without charge. What to do? If you regularly receive cash payments from caregiving, from renting a room, from selling personal items, from family assistance, document the source in writing every time. Keep a simple log. Date, amount, source, purpose. Store it at home and note the existence of this log with your bank in a written account protection letter. We will explain exactly how to file that letter in item number 5. There are 4 more rules ahead, and the protection in item number 5, the one almost no senior has filed, is still coming. Keep watching. Rule number 3, the checking account balance trap. How much is too much and why it matters. Here's a question most people have never been asked and have never thought to ask their bank. Is there an optimal amount to keep in a checking account, not from an interest earning standpoint, but from a federal monitoring and legal protection standpoint? The answer is yes. And for seniors living on retirement income, getting this wrong in either direction creates real risk. Keeping too little in checking creates practical vulnerability, missed payments, bounce checks, overdraft fees, and the cascading credit damage that follows. But keeping significantly more than your monthly expenses in a checking account, particularly in cash-heavy patterns, creates a surveillance profile that federal monitoring systems are specifically designed to identify. The FDIC insures checking and savings deposits up to $250,000 per depositor per institution for each ownership category. That protection is real and meaningful. But FDIC insurance protects you from bank failure. It does not protect you from a civil forfeiture action initiated against your account based on a SAR filing. These are entirely separate legal processes, and one does not shield you from the other. Here's the number that matters for practical account management. Banking compliance specialists and elder financial protection attorneys generally recommend that seniors keep no more than 2 to 3 months of living expenses in a single checking account. For the average retiree with monthly expenses between $3,200 and $4,800, that means keeping between $6,400 and $14,400 in checking, enough to cover emergencies and irregular bills without creating a large static balance that sits in an account making no return and generating unnecessary monitoring exposure. Funds above that threshold are generally better positioned in an FDIC insured savings account at the same institution, a money market account, short-term treasury instruments, or CDs, all of which are separately insured and offer some return on the balance. Here is the real-world consequence of misunderstanding this. A retired couple in Texas, both in their early 70s, sold their rental property for $186,000, deposited the full proceeds into their joint checking account, did not realize that a single large deposit of that size into a checking account with a prior average balance of $8,000 would trigger both a CTR and a high priority SAR flag for unusual account activity. The bank froze $60,000 of the deposit pending a compliance review. The couple had already committed the funds to a contractor beginning a home renovation. The contractor's start date was missed. Penalties of $4,200 were applied under the contract terms before the freeze was lifted 22 days later. In Texas, Florida, and California, states where property sales among retirees generate frequent large one-time deposits, banking compliance freezes on checking accounts receiving sudden large deposits are among the most commonly reported senior banking disruptions. What to do? Keep your checking account balance calibrated to your actual monthly needs, not to your total liquid assets. When you expect a large one-time deposit, a property sale, an inheritance distribution, a legal settlement, a large gift, notify your bank in advance in writing. Describe the source, the approximate amount, and the intended use. Ask the branch manager to note this in your file before the deposit arrives. This pre-notification step is the difference between a smooth transaction and a 3-week compliance freeze. Rule number 4, the inheritance and gift deposit problem, and why receiving money from family can trigger the same flags as criminal activity. This is the rule that generates the most disbelief and the most documented harm. When a parent dies and leaves money to an adult child through a direct transfer, a payable on death account, a trust distribution, or a direct bequest, the receiving family member often deposits a large lump sum into their personal checking account. That deposit looks to a federal monitoring system exactly like a large unexplained cash inflow from an unknown source. The monitoring system does not know it was an inheritance. It sees a pattern. Large deposit. Account with no prior history of deposits at this level. Possible structuring if the deposit is broken into multiple transactions. High priority flag. The same dynamic applies to gifts. If your adult child sends you $15,000 to help with medical expenses, a completely legal gift under the annual gift tax exclusion of $18,000 per person in 2026, and that $15,000 arrives as a wire transfer or check deposit into your checking account, your bank's monitoring system flags it as an unusual large inflow on a senior account. Here is the mortality stake embedded in this rule. When a spouse dies, particularly unexpectedly, the surviving partner may receive multiple financial transfers simultaneously. Life insurance proceeds, payable on death account transfers, pension survivor benefits, estate distributions, all arriving within weeks of each other, all hitting a checking account that previously showed only modest regular deposits. The combined effect on a monitoring system is a cascade of flags at the exact moment the surviving spouse has the least emotional and cognitive capacity to navigate a compliance review. A surviving spouse in North Carolina, 74 years old, her husband passed at 79. She received $43,000 in life insurance proceeds, $18,600 in a payable on death savings transfer, and a $12,000 estate distribution over a 6-week period, had 3 separate SAR flags filed against her account. Her bank placed an administrative hold on $28,000 of the combined deposits. She spent 4 months working with a consumer protection attorney to restore full account access. The attorney's fees were $3,400. In North Carolina, Virginia, and South Carolina, states with significant populations of married retirees whose estates involve multiple simultaneous transfer mechanisms, survivor deposit cascade events are generating compliance freezes at a rate that consumer banking advocates say demands immediate attention. What to do? If you are expecting an inheritance, a large gift, a life insurance payout, or multiple simultaneous estate-related deposits, notify your bank in writing before the funds arrive. Provide documentation, a copy of the beneficiary designation, the insurance policy summary, the estate distribution letter, and ask your branch manager to attach these documents to your account file as pre-notification of incoming funds. This single step has been shown, in documented cases, to prevent the compliance flag from being escalated to a full SAR or account freeze. The documentation costs you nothing. The absence of it can cost you months. And now, item number 5. The protection that banking compliance attorneys say is the most powerful tool available to seniors right now, the one almost nobody has filed. Rule number 5. The personal banking profile letter, the document that changes how your bank's monitoring system sees you. This is it. This is the protection step that sits at the center of everything we have discussed today, and it is available to every account holder at every bank in the country, right now, today, at zero cost. Here is the problem the personal banking profile letter solves. Your bank's automated monitoring system does not know you. It does not know that you are a retired school teacher who receives a pension on the 1st and Social Security on the 3rd. It does not know that you make a $2,500 cash withdrawal every quarter to cover your grandchildren's school expenses. It does not know that you occasionally receive large deposits from selling farm equipment or inherited property. It does not know that you send $1,000 per month to your adult daughter who is going through a divorce. The monitoring system sees patterns, numbers, frequencies, thresholds, and it compares those patterns against behavioral profiles associated with money laundering, elder financial exploitation, and structuring. When your legitimate retirement banking behavior matches those profiles, even partially, the flag goes up. The SAR gets filed, the freeze gets initiated, and you find out about it when your debit card is declined at the pharmacy. The personal banking profile letter changes that dynamic. It introduces you, the real person, with the real context, with the real explanations, into your account file before any flag is ever triggered. Here is what it contains. 6 elements. First, a personal financial biography. 1 to 2 paragraphs describing who you are, your retirement income sources, the typical pattern of your banking activity, and the names and relationships of family members who may send or receive funds from your account. Written in your own words, dated and notarized. Second, a recurring transaction explanation. A written list of all regular transactions in your account that might appear unusual to an outside observer. Cash withdrawals for caregiving, monthly transfers to family members, quarterly, large withdrawals for seasonal expenses, annual large deposits from tax refunds, property income, or investment distributions. Each entry includes the approximate amount, the frequency, and the purpose. Third, a one-time transaction anticipation list. Any large or unusual transactions you anticipate in the next 12 to 24 months. Property sale proceeds, inheritance distributions, insurance payouts, large gifts to or from family members. This list tells the compliance officer reviewing a flag that the account holder anticipated this transaction and documented it in advance, the single most powerful indicator that a large transaction is legitimate. Fourth, a written authorization for your bank to contact your trusted contact person before initiating any account restriction. The name, relationship, and direct phone number of the person to call, with an explicit written request from you, the account holder, that this call happen before any freeze is applied. Fifth, a medical and incapacity contingency statement, your physician's name and contact information, a written instruction for what the bank should do if a medical event affects your capacity, who to contact, in what order, and what documentation exists to authorize their actions on your behalf. Sixth, a formal request that this letter be attached to your account's primary file, made available to any compliance officer reviewing your account and updated by you on an annual basis. Here is the dollar figure attached to this protection. Banking compliance specialists who advise senior clients on account protection strategies estimate that the personal banking profile letter reduces the probability of a SAR escalating to an account freeze by between 60 and 80% for senior accounts with documented explained transaction histories. The average cost of a SAR-triggered account freeze event, including frozen fund opportunity cost, missed payment penalties, legal fees, and credit remediation, is between $3,200 and $11,400. The cost of creating this letter is the notarization fee, between $5 and $15. A retired couple in Minnesota, she a former nurse, he a former electrician, combined retirement income of $4,800 per month, filed a personal banking profile letter with their bank after attending a senior financial protection seminar hosted by their county aging services office. The letter documented their quarterly $4,000 cash withdrawal pattern used to cover a family vacation fund and rotating gift contributions to grandchildren's college savings accounts. 8 months after filing the letter, their account was flagged by the automated system when the quarterly withdrawal occurred. The compliance officer pulled the account file, read the letter, read the recurring transaction explanation, made a 1-minute phone call to their trusted contact, released the transaction the same afternoon, no freeze, no SAR escalation, no disruption. In Minnesota, Wisconsin, and Iowa, states where county-level aging services offices have been actively distributing senior financial protection materials, awareness of account protection documentation has grown significantly in recent years. In most of the rest of the country, the personal banking profile letter is almost entirely unknown among the senior population. Here is the urgency. There is no government deadline on this protection. The deadline that matters is the one you cannot see, the date of the next transaction your account makes that crosses a monitoring threshold. You do not know when that will be. You do not know what will trigger it. What you can control is whether your explanation is already in the file when it happens. Write this letter this week. Have it notarized. Schedule a meeting with your branch manager, not a teller, the branch manager, and ask that it be formally attached to your account record. Bring a second copy for yourself. Keep it with your financial documents at home. This letter does not eliminate the risk entirely, but it transforms the compliance officer's decision from a binary choice between freeze and ignore into a third option: call, confirm, release. That third option is the one that protects your money. Rule number 6, the multiple account strategy, and how spreading your funds reduces your monitoring exposure while keeping everything fully insured. Everything we have discussed today, the SAR threshold, the civil forfeiture risk, the cascade of flags when a large deposit hits a low balance account, is amplified when all of your liquid assets sit in a single checking account at a single institution. The solution is not to hide money. The solution is to structure your banking the way financial protection specialists recommend, with clear functional separation between your accounts and your institutions. Here is the framework. Your primary checking account should hold no more than 2 to 3 months of living expenses. The operational account you use for bills, debit card transactions, and regular spending. Your emergency reserve, 3 to 6 months of additional expenses, should be held in a savings account or money market account, either at the same institution or a separate one. Your longer-term liquid assets, funds you will not need for 6 to 12 months or more, should be in instruments that are not checking accounts at all. Short-term treasuries, CDs, money market funds held in a brokerage account. Here is the FDIC protection math that makes this concrete. FDIC insurance covers $250,000 per depositor per institution per ownership category. A married couple at a single bank with a joint checking account and a joint savings account is insured up to $500,000 on joint accounts, $250,000 per person. If they add individual accounts, the per-person coverage in individual accounts is an additional $250,000 each. By spreading funds across two institutions, they can protect up to $1 million in deposits under FDIC rules, while also reducing the concentration of cash in any single account that monitoring systems evaluate. But the monitoring benefit goes beyond insurance. When your checking account balance reflects only your monthly operational needs, rather than your total liquid net worth, the transaction patterns in that account look like exactly what they are: regular, predictable, bounded, pension in, social security in, bills out, the profile of a retired person managing household cash flow, not the profile of an account with irregular large movements that triggers pattern matching flags. A retired couple in Florida, both 71 combined liquid assets of $340,000 sitting entirely in a joint checking account at a single bank, had never been advised to restructure their account setup. A fee-only financial planner reviewing their situation identified three problems simultaneously. First, they were exposed to monitoring flags because their checking account balance was 30 times their monthly need, making any withdrawal look potentially unusual in proportion to the account. Second, they were earning zero return on $340,000 in a non-interest-bearing checking account. Third, they had unnecessary concentration risk. The planner helped them restructure over 60 days, 2 months of expenses in checking, 4 months in a high-yield savings account, the remainder in a CD ladder, without triggering any suspicious activity flags in the process. Their annual return on the restructured funds increased by approximately $8,200. In Florida, Arizona, and Nevada, states where retired couples frequently consolidate large lump sums from home sales or retirement account rollovers into simple checking accounts, this concentration pattern is both financially inefficient and monitoring profile elevating. What to do? Ask your bank for a written breakdown of your current account structure and balance distribution. If your checking account holds more than 3 months of living expenses, work with a fee-only financial planner to develop a reallocation plan that moves excess funds into appropriately insured, appropriately monitored account types. Do this gradually, in increments that align with your documented anticipated transaction list in your personal banking profile letter, and notify your bank in advance of each movement. The restructuring process itself should be documented in your letter before it begins. Here is what you do this week. Step 1. Audit your current checking account balance against your actual monthly living expenses. Calculate 2 months of expenses based on your regular bills, food, transportation, and medical costs. If your checking account holds significantly more than that amount, identify the excess and begin planning where it should be repositioned. This calculation takes 30 minutes and establishes the foundation for every other step. Step 2. Write your personal banking profile letter. Include the 6 elements described in item number 5, your financial biography, your recurring transaction explanations, your anticipated one-time transaction list, your trusted contact authorization, your medical contingency statement, and your formal attachment request. Keep the language plain and direct. It does not need to be formal legal language. It needs to be clear, specific, and signed by you. Have it notarized at your bank, a UPS store, your library, or your local courthouse. Notarization cost, $5 to $15. Step 3. Schedule an in-person appointment with your branch manager, not a teller, and deliver the letter in person. Ask the manager to confirm in writing that the letter has been attached to your account file and is accessible to the compliance department. Keep your signed, notarized copy at home with your financial documents. Set a calendar reminder to update the letter annually. Step 4. Review your cash transaction patterns for the past 90 days. Identify any recurring cash withdrawals or deposits above $3,000. For each one, prepare a brief written explanation, amount, source, or purpose, frequency, and add it to your personal banking profile letter's recurring transaction section. If you anticipate any cash transactions above $5,000 in the coming months, notify your bank in advance in writing before the transaction occurs. Step 5. Consult a fee-only financial planner or an elder law attorney about your overall account structure. Ask specifically whether your current distribution of liquid assets across checking, savings, and investment accounts is optimized for both FDIC coverage and monitoring profile management. The initial consultation typically costs between $200 and $400. The protection it establishes and the return improvement from repositioning idle checking balances can generate thousands of dollars in annual benefit. You spent your entire working life earning that money honestly. You paid your taxes, you followed the rules, you saved carefully and built something real, a reserve that was supposed to carry you and your family through retirement with dignity and security. The federal monitoring system does not know that. It sees numbers, patterns, thresholds, and when your honest, ordinary retirement banking behavior matches a pattern the system was designed to flag, your money can be frozen, reported, and in documented cases taken, without a single charge being filed against you. Your spouse should not spend months navigating a compliance freeze during the most difficult period of their life because a deposit arrived without documentation. Your children should not lose an inheritance to a forfeiture proceeding built on a pattern-matching algorithm that never knew your name. The letter, the documentation, the account structure, these are not complicated. They are an afternoon of work, an afternoon that stands between everything you saved and a system that takes from the unprepared. Take action this week. Protect what you built. If you know a senior who keeps their savings in a single checking account and has never heard of civil asset forfeiture or the personal banking profile letter, share this video with them today. It is the kind of information that can protect a lifetime of savings in the time it takes to read one document. Next week, we are covering the one estate planning document that probate courts see ignored more than any other, and what happens to your home, your savings, and your family when that document is missing at the moment it matters most. You will not want to miss it.